Okay, this is where we left off with the first presentation, and hopefully you got these problems done. It really is good to bounce back and forth between, listening to this and then, doing a few problems. It's just, it keeps you awake and helps you focus on what you were looking at. Okay, so now what we'll do is look at the standard financial ratios, and there are a lot of them. You don't want to memorize them if you don't have to. I would just sort of have them make sense, So let's get started. The common ratios, what they look at is, can you pay your bills? All right, how is your inventory turning over? Are you selling your inventory and collecting the receivables? All right, I mean, that tells you a lot about a business right there. They also can measure the ability to pay off long-term debt, measure profitability, and then analyze stock investments. So in order to your ability to pay off current liabilities, we've got three ratios here: a working capital ratio, a current ratio, which is used quite a bit, and then the acid test ratio, which has a reduced number of accounts that go into it. So here is our balance sheet here, and this is for working capital. And it's working capital, just think, it's how much cash do I have to buy inventory and let my accounts receivables increase. In other words, for my day-to-day operations. So what we're going to look at are current assets and current liabilities. So if I took my current assets, $262,000, I can easily cover my current liabilities of $142,000. Okay, it's not a really tight measure, but it's not bad. So for 2017, they've got $262,000 minus $142,000 is $120,000, and that's just a whole number. All right, a working capital ratio is a better measure. So we've got plenty of assets to meet our current obligations. And I'm going to keep moving on these, otherwise this presentation will be about a half an hour long. Okay, here's the current ratio, and this one's better. All right, so this takes the current assets and divides them by current liabilities. In other words, how many times can I pay my bills? So, they say a current ratio of 1.5 to 2 is generally strong. That's true, but you'll find, go to Apple's financial statement and let's talk about what their current ratio is. You'd be really surprised. If you've got a lot of extra money sitting in cash, that isn't a good idea either, because if it's just sitting in cash, it's not earning. So some of these really wealthy big companies manage this number to be really tight. Okay, but this is what they're telling us, 1.5 to 2. In other words, you can pay your bills twice over. And their current ratio here was 262 divided by 142, current assets divided by current liabilities. So 1.85, in 2016 it was 1.87. So it went down a little bit, but not by much. All right, not anything to worry about. Now here's the acid test ratio, and that reduces your current assets. It leaves inventory out of it. So this takes cash plus short-term investments. And when they say short-term investments, they mean that like the company has money invested in a money market, something like that. Okay, plus net current receivables. So cash and accounts receivable, and then any other current investments that you had that you could easily liquidate. That's the key. It's got to be able to be turned into cash. And the thing of it is like, could they pay it if it became due right now? So if we add up those two numbers, okay, just cash and receivables, we've got 29,000 plus 114 divided by our current liabilities, 142. So 1.01. Okay, and they're telling us that 0.9 to 1.0 is acceptable in most industries. I think that's true. Does not include prepaid expenses or inventory. So it's just things that we can quickly turn into cash. So now, that looked at liquidity. Okay, those three ratios, those were liquidity. Now we'll look at your ability to sell inventory and collect receivables. And what we look at is how many times the inventory turns over and accounts receivable, and how many days of sales are sitting in the receivable. remember, we're going to compare ourselves to other companies. So then you know whether or not you're in good shape or bad shape, or compare yourself to yourself to the same company in the prior year. So inventory turnover is taking your cost of goods sold and dividing it by average inventory. Okay, now notice that's average inventory, and that is a simple average. All right, that is just beginning of year plus end of year divided by 2. All right, but it is an average. It's not just the receivable or, the cost of the inventory number. All right, it has to be the average inventory. And that's the number of times per year they sell the average level of inventory. So if you think about it again, we're taking cost of goods sold and dividing it by our average inventory. And the high turnover indicates it's easy to sell inventory. And if it's low, then you know that it doesn't move that fast. It's more difficult. So their inventory turnover is 4.6. And if you compared this to, we can't do the prior year because we'd need 2015 for the average. But what we want to do is compare that to prior years or to compare it to other companies in our same industry. Now, accounts receivable turnover. Just like we took cost of goods sold and divided it by inventory to get inventory turnover. For accounts receivable turnover, we'll take sales divided by receivables. So again, we're on the income statement for sales divided by average, average net accounts receivable. So all of your allowance for bad debts, everything is out of there, okay? So sales divided by average receivables, and that is measures the ability to collect cash from credit customers. A higher ratio means you collected more. And when you're doing a problem, and let's say it asks you, do you want it to be high or low or something like that, put some phony numbers in. Say, what if my accounts receivable are 10 and my sales were 100? Then I would take 100 divided by 10. My number would be 10 times, and then change it a little bit and see how it moves. It's always good to, like if you get confused, to have a way to get out of it. So their accounts receivable turnover is our sales were 858,000, and we're going to divide that by beginning accounts receivable plus ending of 114 divided by 2. All right, don't forget this average thing. You'd be surprised how many do, so don't forget that. All right. Oh, and you know what else I forgot to say? On the bottom of these slides, I have, this is too big, isn't it? Let's see. On the bottom of these slides, I've got the Pearson MyLab, I'll post the slides, but the MyLab problem that it applies to. Okay. I better put this back down again, huh? So, what you want to do is, do a little bit of studying and then go back to MyLab and work a problem just so that you're, in better shape on it. So next we look at the ability to pay long-term debt, and there's 2 ways we can measure it, is the debt ratio and then another one called the times interest earned. Okay, remember, none of these really mean much in a vacuum. You've got to be able to compare them to something else. So this is the debt ratio, and what we're doing is taking total liabilities. Okay, so here's, in other words, it's like debt versus equity. Okay, so our assets are financed by the liabilities and stockholders' equity. So you can see here that our liabilities are funding more than 50% of our assets. Okay, it's less financed by stockholders' equity. Okay, so it's total liabilities. Total liabilities are 431 divided by total assets. Okay, so that tells us that 55% of our assets are financed by debt. All right, and for a lot of different reasons, people look at these numbers. The higher the debt, the greater the risk, because you can put off paying a dividend, but you can't put off paying interest or paying off your bills. Okay, so sometimes equity financing is considered safer or less risky. Now, times interest earned, we're going to take operating income. Now, remember, sounds dumb, but this is really an important sequence of accounts to really know. So it's sales less cost of goods sold is gross profit, less operating expenses is operating income. Okay, now operating expense does not include interest or taxes. These are non-operating expenses. In other words, these don't have to do with the operation of our business. Okay, so what we're doing is we're taking income from operations, or operating income, that's what that is, and dividing it by interest expense. And that's the number of times operating income can cover our interest expense, and what we want that number to be high. All right, so their number here looks like it's increasing. In 2017, it was 101, that's operating income, divided by interest expense of 20,000. Okay, so 20% of their income is eaten up by interest. But that ratio is 5.07. Yeah, which is increased from the prior year, so they're in a slightly better position. Now, profitability measures are, I think they're easier to see, but these aren't bad. These could be worse. It's not bad. The first one is gross profit, which you should know right now. Then an operating income percentage, and this is just logical when you look at it. Then rate of return on net sales, return on total assets, return on common stockholders' equity. Now, whenever you see, I'm going to say return on equals net income. Okay, that's the quote return. So now I've got it increasing. Insert a picture or a arrow. See, from here to there. Okay. Return on, that's what return on. Return on means net income. So this would be net income divided by net sales. Net income divided by total assets. Okay. Return on common stockholders' equity. So let's take a look at these formulas. First one is the gross profit percentage, and this you know, right? You know this. So this would be gross profit, okay, divided by, well, first of all, your gross profit is sales revenue less cost of goods sold, right? That's what gross profit is. The gross profit percentage is this 345 divided by 858. In other words, I mean, this is a really good number because it's consistent, it's comparable from year to year. This is how much before our operating expenses, this is how much we're making on our sales. So it measures the fraction of each sales dollar that's profit or markup over cost. Okay, so in 2016, our gross profit percentage was 36%, and in 2017, it's 40%. That's a very large increase. Generally, gross profit doesn't change that fast or that high, especially in a supermarket. Okay, this is part of vertical analysis. All right, but it's a key number, and you can compare yourself to look at the gross profit percentage in similar industries too, and use that as a benchmark to see where you are. Operating income percentage, same type of thing. Operating income divided by net sales. So for every dollar of sales that I have, how much ends up in net income? Okay, or operating income 101. Okay, now they say this, you want to pay attention right here. This reflects pricing decisions and efficiency in controlling expenses. That's what it tells you, because we're looking at income from operations. All right, so in 2017, it was 7.1%, and it increased quite a bit in 2016, 2017. It increased quite a bit to 11.7%. All right, and again, that is operating income divided by sales. Okay, so for every dollar of sales, how much ends up in operating income? All right, and don't forget, remember this operating thing. It's operating income. It's really easy to reach back for net income. Almost there. I know this is long. This is the rate of return on sales, and this is net income divided by net sales. Okay, so net rate of return on sales. So return on, remember that's net income. So it's going to be net income divided by sales. So for every dollar of sales we have in 2017, we've got 5.6 cents or 0.056 of return. Okay. Here's return on total assets, and this is a really important number. None of these measures are trouble-free. Okay, so they all have issues. Like we've got assets, we're using total assets, return on total assets, and these values, these are all current values in here under, pretty equivalent to cash in a lot of ways under current assets. And property, plant, and equipment, this value is cost less accumulated depreciation. So it has no, very little resemblance to what the fair market value might be. Okay, there's really no relationship. So this can make it funny. All the long-term assets can give you problems. So this is going to be net income. All right, I lost net income. Here's net income, $48,000 plus interest expense of $20,000 divided by average total assets. So that would be 787 plus 644 divided by 2. All righty. Okay, you've got a lot of practice in the homework on this. And that's about all you can do. Did I lose return on total assets? Okay, rate of return on common stockholders' equity, or return on equity is what it's called. So now this is net income minus preferred dividends. And the reason for that is that we're looking for the income that's available to the common shareholders. So if they're paying preferred dividends, we take those out first. Okay, so net income minus preferred dividends divided by average common stockholders' equity again. Okay, and it's the relationship between income and common stockholders' equity. There are a lot of different ways that you can measure valuation of a company, and this stockholders' equity is not in here at market value, it's in there at cost. Okay, so there's different caveats. How much income is earned for each dollar invested? So we don't have any dividends here, so it's 48,000 minus 0 divided by average common stockholders' equity. So that would be 320 plus 356. And the thing to remember about this, common stockholders' equity, I'm going to add a line here, includes retained earnings. Okay, that belongs to the shareholders. The common shareholders bear the ultimate risks and rewards of ownership. Preference only means preference as to dividends. It doesn't mean it's better stock or it pays more or anything like that. Okay, a preferred stock is actually counted as debt on some SEC filings. All right, it's a little counterintuitive there. Now, earnings per share. This is actually a very complex topic, but we're going to take net income minus preferred stock divided by the number of common shares outstanding. And the number of common shares outstanding is the stock issued minus treasury stock. And I don't know if you remember, but treasury stock is our own stock that we bought back on the market. Okay, and it's held in our treasury. EPS has to be shown on the income statement, And it shows us the amount of net income earned for each share of the common stock. Okay. Tricky number. There's a lot of accounting research on whether or not this number has any value, if it has any information content. I'm not sure it does, but EPS is, in this case, it'd be 48,000 divided by 10,000. Okay, because we've got assume no preferred stock or dividends and 10,000 common shares. So 48,000 divided by 10,000. In the prior year in 2016, it was 26,000. Okay, there's your income divided by the 10,000. The shares didn't change. Okay, almost there. Now to analyze stock investments, we'll look at three different things here: a price earnings ratio, dividend yield, and book value per share of common stock. This is book value. I'm going to say as opposed to market value. Okay, so book value. So the price or PE ratio, it shows the market price of $1 worth of earnings. So we'll go to, like, a good place to go is Yahoo Finance. All right, is a good place to look for that information. I'm just going to say, that's because you can look up any stock there, and they've got a lot of trend information, a lot of information about what's happened to the stock price, say, over 5 years, and it's pretty interesting. Let's say, so the market price of the stock divided by earnings per share. All right, so that gives us the market price of $1 worth of earnings. So in this case, we're assuming that the market price of the stock was $60. Okay, and we had earnings per share of $4.80 in 2017. So our PE, price to earnings ratio, would be 12.5. Okay, and this is a good way to compare stocks. For dividend yield, this is the dividends per share of common stock divided by the market price per share. And that tells you how much of what percentage of a stock market's value is returned annually of stock market value, rather, is returned every year as dividends. Okay, so they pay, this company, Supermart, paid cash dividends of $1.20 in 2017 and $1 in 2016. The market price was $60 at the end of 2017 and $35 at the end of 2016. So if I take my cash dividends of $1.20 and divide that by the price of $60, that gives me a 2% return, or 2% yield. Okay. Book value per share, this is pretty straightforward. This is total stockholders' equity minus preferred equity. So remember, total stockholders' equity will be common stock plus retained earnings, okay, divided by the number of shares of common stock outstanding. Okay, it's outstanding. Assume 10,000 shares of common stock are outstanding. The book value per share would be $3.56. Total stockholders' equity, that's what that is, and we don't have any preferred equity, so minus 0, divided by 10,000 common shares. The book value per share is $35.60. It's a lot of formulas, isn't it? Now, red flags in financial statements, what we look for, things to be concerned with, whether you're an internal or an external auditor. Okay, look for earnings problems, too much debt. Look at the movement in sales, inventory, and receivables, and look for aberrations and trends. The inability to collect receivables, or if inventories are building up, those are all red flags. Okay, where a company might do something that they probably shouldn't do. And finally, sustainability in financial statement analysis. This focuses on the triple bottom line. It's moved on, environmental reporting has really matured, and I think it was born as a field around 1980, but it's because of all the pressures that we have on the planet, it's becoming more important. So here's more than 1,500 institutional investors with 62 trillion in assets have signed on to the principles of responsible investing. So what we look at are environmental factors, social factors, and governance in an investment decision. You can find some information in the 10K, but really not much. You've got to go to the Corporate Social Responsibility Report, which is not audited. All right, and they're kind of glitzy reports where people brag about what they've been doing a little bit, So, but at least this information is out there. All right, so what we're doing then is trying to have an integrated report that has material or significant, right? Material changes a decision. Okay, move this up. Okay, that's what we mean by an integrated report. Now in my lab, you've got 4 problems left, and they're more difficult problems, and they cover the whole chapter, but they're great practice, and then you're finished with this. Okay, all right.